Hello, coming to you today on September 19th, 2016, and this is part 3, so that I hope you have seen parts 1 and 2 of structure-based trading plan with strategies and tactics. I'm going to flesh out much more detail things we covered on the first 2. First of all, don't forget, futures trading contains substantial risk and is not for every investor. So you can go to my website there and you'll see that warning, and you'll see lots of free information. And today we're offering free information on how to go from our trade plan to actually structuring entries, exits based on principles of market structure and the market profile theory. And what we're looking at, we're zeroing in more and more on the actual practice of applying these things we looked at. And in the first 2 videos, you'll see how I talked about just adding a few simple things to the basic naked price action, that we're able to get a lot of information, and we can get closer and closer to having very clear-cut objective entries and exits, and that's what we're going to be talking about today. So we talked about how I just put up this one moving average on a 2-minute chart I'm using, and you could use other time frames like 5-minute or 1500 tick or whatever you like. But what we're looking at is we're going to combine 2 time frames, and I'm combining the 2-minute on the left and the 125 volume on the right. And today we're going to look at lots of knowledge that's offered simply by putting the moving average on the bars. And what we're looking at here with this very short-term 125 volume time frame, we have 2 moving average, and they're going to give us very specific action points based on our criteria that we create, and that's where personal coaching comes in. So what I'm offering is for an individual to come up with a trade plan like this that's exactly tailor-fit to what an individual trader needs. What capabilities does that trader have? How experienced or inexperienced? And what is comfortable and what they can execute successfully. All of these things are different for different people. So that's why customization and personal coaching can be valuable for somebody who's just at that point where they've been trading for a while but wants to figure out how to make more money and do it more consistently by being more disciplined and structured. So what we're looking at with what we talked about on the previous 2 videos, we learned that by putting up this moving average and adding the previous day's high, the previous day's low, and the close from the previous day or the current day's open, we get a lot of information, and oftentimes the market is keying on those levels for the direction it takes and the places of support and resistance where it turns. And what you have also with the pivot numbers, we have the daily pivot and the resistance 1, support 1, etc., point 2 and support 3, and all these different levels. The market is going to find itself acting upon 1 or 2 or 3 or 4 of them on any given day. So getting back to what we are looking at now is the use of 2 time frames. How is that easy to do? How is that even possible? Why? How do you decide whether to use the longer one or the shorter one? Or maybe it's just more confusing. Well, the idea, if you're going to combine time frames, is you want it to be easier. You don't want it to be more confusing. Therefore, we want to create a simple criteria, and that's what we talked about more on video 2, where we were looking at this 2-minute chart with the moving average, and again we decided to either use a 39 or a 30 or a 26 or a 34 Fibonacci level. All these are in that same range, where we're going to find that price tends to, a lot of times on a sideways day, it'll just rotate around above and below, and on a strong breakout day like this, then the slope will be much stronger, and the way we make entries might be a little bit different. So we're applying the structure approach, which we did on the first video, to this as well. So we're noticing that it broke out of the lows here earlier in the day, shortly after the open, the first hour of trading, which is what we key off of. And it right as soon as that 9:30 low was put in, a few minutes later it broke under that. But it had to contend with this prior day's high as up here, the market, this was a support point because resistance broken is support. But they got through it, but they weren't convinced, and then it waffled above the previous day's high again, but then it broke hard. So this is what we're looking for. We're looking at definitive direction that we can identify and do something with, and then we're looking for location. And basically everything I've been talking about in these 3 videos so far is about my preference is to buy low and sell high. So you could look at that. People might call it fading extremes or support and resistance trading, but it's all in how you put it together, whether you're emphasizing trading extremes or simply looking for support and resistance. They might actually be different things in some cases. So in this case, it came down to the support one, fell a little short of it here, probed it and was strongly bounced, but then the third try again was the charm. This is our principle of 3s. So 3 drives to a bottom is very common. 3 drives to a top is very common. And it can be on different scales. So here are 3 quick peaks, which signaled the end, the exhaustion of that upward direction. And then when they got to the pivot, they tried to stay above it, and they broke hard again. But then they came down, and this time they hold the previous day's low, and that ended up. That's the way the market ended up. It held firm, 1 tick above the previous low, and then it didn't come back too much before the close. Now, how do we combine 2 time frames? The idea is we want to use the shorter time frame, again, to make it easier, not harder. We're not looking for every trade to just be exactly what the longer term chart is showing us, because then we might as well just trade that. We might as well just trade a 2-minute chart. So what is the value of the shorter time frame? The value is for getting more trades, more aggressive, more entries, more chances for profit. That's my opinion. That's the way I try to create my trading plan, and my choices of strategies and tactics is I want to be able to get more trades, because if my method only gives me 5 trades a day, chances are I'll miss 3 of them. I bet there's some of you out there who've noticed that about trading. It's real easy to miss those perfect setups that only come along 3 or 4 or 5 times a day. That's where the shorter time frame can really help out. And I'll give you some examples now. And in the process, we're going to learn how to do it. And when you get down to working with a coach on an individual basis, then you're going to create it more optimized for an individual trader. But I'm showing things that can be applied to most people. At least it can help you to start understanding how you might go about trying to combine 2 time frames. So what we're looking at on this 125 volume chart, 2 moving averages, the 26 and the 90. So I like to get a little shorter on this, and so rather than use a 36 or a 39 or a 40 or whatever, we want to get a moving average which is going to be a little more conforming to the highs and lows in price. We don't want it to be too far away from the moving average so we don't get a trade. So if we look at the two time frames here on the 125 volume, right here is where it hit the MA. And right here is where you'd like to get an entry. Now look over on the 2-minute chart, and you'll see there was our pullback. So right here is the first time back after the crossover of, let's say, the 35 moving average or whatever it is. So this first time back is a beautiful pullback after a really strong impulsive move. The chances are they're going to buy any dip they can get their hands on, maybe just 6 ticks off the high or between 6 and 10 ticks. So that's a really great place to get in. But what we have when we combine the small time frame chart is it's much easier to recognize that this is where we want to be putting our entry in, is a couple ticks maybe above the moving average here. And if maybe this one here, we have two things that we're looking at. When we combine two moving averages is how big is the distance between the two, and if price gets in the middle of the two somewhere, I call it a pocket, anywhere in that pocket is a great trade because we're on a real short time frame chart, so we can get in tight and we can, give it a maybe 3-point stop or something. And in this case, if you got in around here, 825 and went down to 99.50 or something, it only would have gone 5-6 ticks against you. And I don't recommend stops that tight in most cases. I like to have a little more room and have a higher percentage of winning trades. But at any rate, here's advance warning from the time of 119 up to 130. So you had all those bars giving you an opportunity to entry wherever you felt was your preference, either as soon as you got a chance to get in or waiting for absolute cream of the crop, cherry picking right to the tick, and that's when what you're going to get more of on moving averages on a shorter time frame chart. So just to look at some of the things we look at on this short time frame chart, we look at the direction of the market from the slope of the moving averages. If they're sloping strongly up, you want to buy dips. And where do you want to buy dips? When they're in the pocket somewhere. Okay? Now, you can trade pullbacks or extremes. If you get in way down here, actually on a very short time frame, that's an extreme because it's the low of this range. So extremes can be extremes in a very short period, like a half-hour extreme, or the extreme of the day, or any of number of different ways of looking at it. Extremes means we're picking up a bottom. We're picking a bottom on this market somewhere. This is an extreme. Now, in here, in and of itself, maybe that's too extreme because you figure, well, I'm way under the previous day's low. So you look over here, though, at the 2-minute chart, and it's not so far-fetched, is it, to think that maybe they're holding that low. If they get back above it, maybe they'll buy it strong, and that's actually what happened. So the shorter time frame gives you some leeway. It gives you some kind of waffling room in your decision making because you have a lot of chances to get in here. You got a double bottom here. You've got a low here, which was broken, but only by a couple of bars on, this is just a few seconds when you're looking at the 125 volume chart. So then it regained this low right here. So again, that's what we're looking for. We're looking for regaining lows at the bottoms and regaining and failing on our retest of highs when it's a market top. So up here, we're looking for a crossover if it's going to break that previous day's high, which it did. And once again, when you go over to the shorter time frame, you found that it was a time to take a moving average crossover. You see, by combining two time frames, The longer time frame can tell you when you want to take that crossover, because I don't know about you guys out there, or gentlemen or ladies, I've always found it really tricky to want to take a moving average crossover because so many times they seem to go back and forth. But if you're looking at that 2 minute over there and saying, well, it sure sat on that previous day's high for an awful long time, I guess they're deciding they're not ready to buy it. And so the last little stab at a high there, only one bar penetrated above those previous 3 high bars. So now I'm looking, where do I get in? When do I finally make up my mind I'm going to make my stand and take that moving average crossover? Well, that's what you do over here on the 125 volume. And over here on the shorter time frame, here's where you can use a tight stop. It breaks under previous day's high, and you know you got a point over here that's likely kind of the farthest reach. If it's going to break that, it's probably going to keep going. And so, you know, you're only risking 1975 to 1850. So that was 5 ticks in the range of those bars there. So if you got in down here, you could risk maybe 10 ticks, and, you know, we're talking a very small risk on the NASDAQ to go 10 ticks. So we have a crossover that is a very strong momentum, and you may decide you don't necessarily want to limit yourself to scalping if you can get trades like that with a shorter time frame. So these are just some of the points we look at. Maybe I'll do one more video in terms of going into a little more detail and depth. If you have questions, go ahead and send them. As I mentioned last time, I'm very accessible, and I put my phone number right on my blog there. So if you have questions, go ahead and go to contact, and there's my phone number, or so make it easy. But otherwise, I'll probably keep making videos for a while for those of you who are strictly wanting free information. I hope I can help you, and we're gonna look at that maybe a little more deeply in a future video, where we'll go into all of these points so you understand what I'm talking about when it's given more attention. And you'll find that, again, you don't need a lot of complicated indicators, but you use a market profile kind of an understanding of the market, and look at market structure and price action patterns of behavior, and you got everything you need to be very objective about making your decisions, so to be consistent and committed to following your trade plan and executing when the opportunities arise. So I hope that helps. Happy trading.